Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today we're going to do our normal EIA show, and we're going to break it down into the three typical topics of an overview, a deeper dive into refined products, and then a look at exports. So just to get right to it, we had a decent draw across the board from crude stocks. And the key component that we've been talking about is you have to look at the SPR as well, because about 2 weeks ago, we saw that we were going to start to see some draws coming out of the Strategic Petroleum Reserve, which was a place to store crude over the last, call it 6 months or so, as COVID really kind of struck. So here you can see that on just the top level, you had a draw of about 4.5 million barrels, but then when you aggregate the SPR, it was actually a draw of about 6.75. Now, those are things that should continue over the next 2 or 3 weeks, just because during August is when we get more of an acceleration to the downside. Now, the estimates were about 2.5 to 3 million, depending on who you were talking to. So regardless, this is a good number. But it was mostly driven by Pad 3, which is really an aggregate of exports increasing, imports declining, and then runs kind of just staying relatively stable. So this is something that we should see continue for the most part in terms of just some additional draws, especially when we factor in the SPR. The bigger change that you might see is that decline of 300,000 barrels. Now, the problem was the EIA overestimated production during the COVID strike. And if you look at their short-term outlook, which was released the other day, they had an adjustment of about 1.2 million barrels, which kind of gets you to where we were. So we thought that we had gotten to about 9.5 to 9.7 million barrels a day of U.S. production, and they came in at about 9.75. So you kind of get an idea of where they have to make these adjustments. So we still believe that we're at about 10.9 to 11 million barrels on our way to 11.3, as we do see some completion activity starting up, and which should accelerate through September, as we talked about on our Friday show. And then we're going to start to see some of those shut-ins that were kind of still around, that are starting to get come back online. And now when we look at it, we always have to consider it from where we were on historics. So even though we had a nice draw for the week, you can still see kind of where we are in terms of the size of the glut. Now, this is something that is still a positive, it's moving in the right direction. But again, on a seasonally adjusted basis, which is a slide that we're going to talk about at the very end of the show, you can kind of see that we're following the normal trend. We're still grossly oversupplied in terms of where we should be on a historic level. And then you can see how that is really magnified in Pad 3. So Pad 3 is the one that we always really look at, because this is where you're getting the exports, the imports. This is where you're starting to see some of these problems that could show up, especially as we go into the shoulder season, where we're going to get an additional decline in terms of run rates, as well as crude storage that typically builds in the fall months. So there's some things to talk about specifically in imports, runs, and whatnot. So Marathon Petroleum has officially decided to close their Martinez refiner in California. As we were talking pre-show, the last place I'm going to want to buy gasoline is going to be in California once COVID is over, just in terms of the amount of refiners that have come offline. And here you can see the imports, in terms of where things are. And when you look at imports, you can see that there was actually a big increase in Pad 5. Now, this is always going to be timing. So Pad 3 had a small drop. Some of the other pads had some small drops, but Pad 2 had a big spike last week, and you can see some of those increases still kind of remained and carried over. Even though week over week it's a little bit it's lower, you can see against the 5-year average, we're still about 141,000 barrels a day above where we normally are. So this is something where we expect to see an increase in Pad 3 imports. Again, nothing to be crazy about, but you're starting to see some of those adjustments. Now, the runs we need to talk about where the runs are. So the PES refiner has now been taken out of the numbers. So on a week over week level, we're still at about 79.6 or so. So there's not much of a change, but you're starting to see that come out. So the numbers will start to make a bit more sense. We still feel the same way about averaging that 75% through the summer. We came through at low rates. That this is going to be a little bit of an adjustment. We talked last week how pad 3 was going to be down. It was down about 200,000 barrels, and you had small increases, here and there. But again, this is something that will start to drift lower as we get to the end of August into September. Now, implied demand had a nice increase, and we'll talk about that a bit more. But the one that we want to focus on is obviously gasoline and distillate. Now, gasoline was that timing delay. We had the big storm that hit the East Coast, which really kind of impacted how people filled up their tanks. Everyone filled up their tanks ahead of time. They got extra gas for their the backup generators. Those are the kind of things that will really kind of adjust. And now all the gasoline has to backfill where you saw those big draws. And now we had another storm that hit the Midwest, which will also, adjust the way these things look. But regardless, it is still a good number, and it's something that we're going to talk about in more depth. So now as we go and we start to look at floating storage, you can see that there was a slight increase in floating storage. But again, we're going to kind of suck around this 5-year average now that things have normalized. You had a reduction in crude purchases as official selling prices globally went up. You saw a decline in purchases. Those are things that are going to start to adjust as we start to see some discounts appear in the market, specifically out of areas in Latin America, West Africa, and the Middle East. So you'll start to see that creep higher. But again, it's going to be oil in transit before it becomes oil in storage, because oil in storage happens after or is classified as such when a ship is stationary for 7 days or more. And that's where you're starting to see those import data really show up in pad 3, where we continue to kind of drift lower versus the seasonal norm. Now, this is something that, again, we're going to see a little bit of an increase as you have pad 3 refiners starting to pick up a little bit. And this is going to pull in more imports. So you'll start to see this reverse. Now, we always talk about those timing delays. So exports actually increased. Exports of oil, which is always going to impact the import capacity. So you'll typically see that flip back and forth. So that this is something that will flip the other way. But again, we're still going to kind of be sucking around that lower end of the range. And that's where we start to turn to the utilization rates. Again, utilization rates will still remain well off of seasonal norms, but we're starting to see some of that creep back up. But we're also seeing additional pressure that remains within the refining universe in terms of margins, crack spreads, and just the inherent differentials that we're seeing, which we'll talk about a little bit later when we go through exports and how things are adjusting based on how pricing is becoming a bit more competitive as discounts start to get priced into the market to move product into the floating universe. Now we turn to refined products, and we're always going to start off with diesel just because it's an interesting market, and it's really where the lifeblood has been over the last several years, especially when we look to industrial production. And here you can see distillate had a decent draw of about 2.3 million barrels, but you can see the level in which it's coming off of. So we did get a pickup in terms of domestic demand, and we did see an increase in exports, which is really what's accounting for the draw here. But you can see the pace still remains well above where it should be at this time of the year. And the problem that we're going to see as we go into September is heating oil, which has, just based on new regulations, which is essentially diesel. So here we're going to start to see some pressure because we're already well above where we should be on a seasonally adjusted level going into the fall season when you start to build up some of your heating oil reserves. So how are refiners going to increase runs when you already have a huge glut of product that you're going to hope gets drawn down from a very cold winter? So these are the issues that the refiners are going to be facing, and where we remain cautious oil demand as we go into the shoulder season, which is usually measured between let's call it, typically Labor Day until the first week of November. And again, that can change based on how early winter comes, but we typically have seen winter not really start until, essentially November, just based on the way the warmth has been through Halloween. So these are going to be key issues as refiners start to dictate, should we cut further in shoulder season in order to offset? But then there's always a question of how far can you cut without actually just shutting down the full facility, because pressure has to remain in the cracker, in the coking unit. So there's a certain line to walk, and then obviously cost is a huge problem, which is going to be problematic as we start going in. But again, these are things that we'll discuss as we get closer. And the big component was, we kept saying that the distillate demand was going to kind of stay around the 5-year average, just because we do have some positive news, to kind of outweigh some of the negative, which is why we think distillate is going to hang around this level. You saw a small increase. Again, this is a calculated number, so exports helped, in terms of, and then if you consider where we're going to go going forward, and this is why we always turn to the two specific components for the U.S. Shipping is obviously another one. Shipping remains relatively soft, which is something that we think is going to continue through the end of the year, just given the economic backdrop. But here you can see rail traffic came down again. It fell about 18%, 18.3% versus 2019 on total car loads week over week. And then when we do year to date, you can see it's continuing to creep higher. And this week versus last year, you can see that everything had a decline in terms of trends when we're looking at total car loads, chemicals, and other. And again, this is where we remain cautious, which we'll talk about in our economy show, which we get to film today, but you'll see tomorrow, where we really kind of talk about what is driving these different components and why we remain cautious, the economic growth, specifically in the U.S., because a lot of these key aspects are really feedstock into the industrial production. But we've been talking about this for 2 months. This is something that is now catching the bulls, and they're running with it. But you can see this is where market demand continues to increase for trucking. So trucking remains the bright spot, which is why you're getting that bullish move. And you can see the market demand index continues to shift higher. And it's really taken out those 2018 highs, which was really the peak. Now, the problem is there was a ton of capacity coming into 2020. You had several bankruptcies that happened from in 2019 into 2020, which took some of that additional capacity out. But at the same time, you can see that on a spot level, when we look at rates remain well below 2018. Now, this is a mixture of two different components. One, there is more competition because there's just more trucks available. And two, diesel prices remain very low. So diesel prices obviously weigh into the rate. So between the competition increasing just to get your utilization up, and then diesel prices, you can see that rates remain well below 2018 highs. But again, they're having that upward trajectory just as companies utilize the trucking market versus rail and shipping to really get stuff around the country, which is something that we think is going to continue well through the end of August. Then the question is going to be, what does back to school look like? And does some of this start to pair off as back to school, potentially disappoints, which we think is more than likely. Now, when we look at gasoline, again, the trends are typically to the downside. And here you can see it's really flattened out. So we had a small draw of about 720,000 barrels. And it was really driven based on a little bit of a draw across the board, specifically pad 1, 4, and 5. Pad 1, depending on how you calculate what it is, you can kind of see the mix because RBOB is just reformulated. So that's one that matters a bit more. But you can see the flattening of the line. We're just not seeing the gasoline demand really come through. And again, this is due to the timing delays in terms of people filling their tanks ahead of storms, new storms hitting, but also imports. So imports have increased into pad 1 or the East Coast by about 363,000 barrels a day. Now, this is something that's going to continue based on what the arbitrage looks like. not only into the US, but also into Latin America, which we'll talk about in a minute. The bigger issue remains where we sit on a relative level and how we've kind of flatlined as these refiners have started to increase a little bit. They've increased their production of gasoline, and we're just not seeing that demand really show up in a meaningful way. And this is some of the Gas Buddy data that we've collected from our friends on Twitter. And here you can see you're starting to see a little bit of an increase. As we went into Tuesday was a stronger period. But when we consider Friday and Saturday, you can see that we did pare back versus the end of July. So again, this is where we continue to see this plateau kind of back and forth in terms of who does what. And that's why we talk about the year versus a year ago. So according to Gas Buddy, we're still down about 17.5% year over year. Now, the vehicle miles as the Department of Transportation, we were up a touch, about 1% in terms of where we ended on August 2nd, which accounts for a decline of about 14%. The bigger focus, and this comes back to the trucking component, trucking is miles traveled on interstates is actually up 1% year over year, which again comes back to that demand level where we're seeing some of those bright spots. And then not surprising, the Northeast had the biggest drop year over year. And again, this is the storm coming through, and we saw a decline last week of 21%. Now, some of that will come back in terms of the East Coast, but that's going to be offset by some of the damages that we've seen in the Midwest as that storm came through. So here you can look at it a little bit differently. And again, it's going to continue to bounce. We continue to believe that about 8.5 million barrels is where we're going to sit as we go forward. And you can see us just kind of waffling within this tightening range. And again, this is something that normally rolls off as you see the normal trends as we go into September. And that takes us into jet fuel. So jet fuel demand is something that we've been talking about, coming down, starting to level off, and we're continuing to see that here. So we saw demand fall back a bit, and it's something where the supply demand remains relatively in place, where refiners continue to recover some of the additional jet fuel, which again is why distillate is seeing a little bit of a bigger drop. But that demand just remains, again, in that tight range, as you can see from the TSA, where we had a nice little new high for 2020 as we breached that 850,000 passengers. But again, we continue to stay within this relatively tight range. We hoped, and as people start to feel a little bit more comfortable with reopenings, you'll start to see the lows, the higher lows and higher highs. But again, just because there's been a huge change in business travel, we're really not going to see us close this gap, but we are going to see a little bit of an appreciation where we'll get closer to that 850,000 passengers a bit more consistently, especially as we go through the end of the summer, just because we've seen COVID cases start to get reduced. How does that look as we go into cold and flu season and kids going back to school? That will be something that we're going to keep an eye on, because you could see this kind of roll back down. But again, things look fairly stable right now. And this is where we look at the Google mobility data. And it may look like we didn't update the chart because it looks relatively the same, and it's because we haven't seen much difference. And that's why when you look at the general trends, the trends remain relatively stable sideways. And that's where we look at it from a heat chart perspective. So this is a mixture of mobility data and restaurant bookings. And you can see that essentially since June, we've been relatively flat on the mobility side, which again is really showing up in that Google mobility chart. And you're not seeing much to the upside in terms of people doing anything really additional. And that's something that we think is going to, again, remain relatively consistent as we go into September. And then restaurant bookings is something very similar in terms of, there is a restriction in terms of the amount of people that can be in the restaurant, outdoor seating versus indoor seating. So this is, again, something that has been relatively stable since about June 19th with very little movement up or down. The mobility index is the most important one as we consider where are people going? Are they spending money? Are they consuming gasoline? And this is the trend that we continue to see. And again, this is mostly looking at, not mostly, this is only looking at the US, but this is something that we're seeing a trend that appears across the globe. This is just, as the EIA is the US data, we wanted to look at what's happening in the US and how this is really impacting those gasoline numbers. And this is just another view as you see some of those trends shifting a little bit better on open table on a global level. Again, we're getting back to the high that we saw when we had those peak reopenings. The problem is going to be, where does that kind of shake out? And we think that we're at this comfort level. And the reason why we can say we're at that comfort level of kind of, the higher highs, the higher lows, but again, within a margin, here you can see kind of that global move where if you remember back on a global level, we're at 65% declines and now we're at about 50%. And that's because we've seen a resurgence in the UK. We've seen some UK reopenings. Again, the US remains within this 55 to 60. So that's why the global view as we go forward, we think we're going to kind of hold that 50% decline, but it's going to ebb and flow. And that's where the question is going to be, how does Germany continue to handle some of the increases in COVID cases that we've seen? But again, this is where we start to look to exports to see how is Europe and the US going to essentially compete in the export market. And this is where we turn to exports. And now you can see that there was a nice increase in exports, specifically in distillate, which is something that we were talking about the other day after we had a decline. And it's going to be relatively in this confidence range. And it's just because we've seen some pricing discounts and some increases going into Europe, which we'll talk about in a minute. Now, gasoline is one that continues to see some movement. And again, not to say that we're getting to the point of gasoline, quote unquote, going bad, but you have to keep gasoline moving because gasoline does have a shelf life. And you have to think about, okay, well, how is the shelf life? How close are we? Do we need to start to see some movements? But at the same time, refiners throughout Latin America remain near lows, specifically in Mexico. So you're starting to see some of those gasoline exports move in as their local production is impacted. Now, the exports is the one that we continue to talk about. Is going to move up and down, specifically because a lot of these exports were sold prior to the decline in official selling prices out of places like Saudi Arabia and other. Now, the problem is most of this oil is moving into Europe, and we saw a relatively large cut in Saudi OSPs into Europe. We're starting to see some movements in terms of refined products into the area outside of just the U.S. So these are things that are going to weigh on additional oil exports. But again, in terms of where our product is going to be flowing, and here you can just kind of putting some color around the European move. So European imports of refined oil from the Americas this month are set to rise. It's going to be the largest since March, where most countries, obviously had their lockdown. So 24 tankers are right now are going to be hauling about middle distillate. So these are things where middle distillate or distillate fuel oil will see some support as we go through the remainder of the year. And this is something to watch to see if we start to see some of these draws increase, counter seasonally as we go through the end of the year. The problem on the oil export level, where the competitive nature of U.S. crude is being impacted as we've seen some of these discounts come into the market. So that's one thing to watch when you consider the Brent versus Louisiana Light Sweet and Magellan East Houston. Those are going to be the ways to kind of gauge what does the discount look like to really incentivize others to buy our oil. And right now, things are a little tight, so you're going to see some of those declines in terms of export demand until we start to see some of this widening of the differential. And here's where you can start to see some of the gasoline exports. We talked about how we were going to kind of hang around this 5-year average. We had a big increase. Again, it's just going to be timing delays. This is something that we think is going to pare back as we go through this week and into next week. And again, there was impacts from storms, movements around the Gulf of Mexico. So this is something where we think is going to normalize as we go through the next 2 weeks. The bigger one is distillate. This is one where we talk about kind of average, hanging around that average. And just to kind of clarify where things are moving. So European fuel exports have actually increased into West Africa from May's low as we went through July. And that's something that is interesting because we're starting to see Europe increase their exports into West Africa. But at the same time, we're starting to see them increase imports from the US. So there's a little bit of an arbitrage that is opening up, which they're trying to take advantage of, which is just trying to supplement some of the pain that they've seen on the margin when you consider, where they're how they're really not making much money when you're considering the refined products. Now we've also seen some crude units halted. Dongus went down. It's halted about 220,000 barrels a day. That's something that will impact, which is again why we're going to see some of those imports that are going to move. But realistically, imports are from middle distillate, and that's a key component in terms of, what's moving? And that's why we think, even though we said last week that we're going to kind of hang around that 5-year average, we will get there, but we're going to hang above for the next few weeks as we see an increase, and then we're going to get back down to that average level as we go through the remainder of the year. And the reason why we think there's going to be some pressure is when you look at diesel demand going into Argentina, Mexico, Colombia, Brazil. So you can see that diesel demand has started to come off, specifically in Argentina. Gasoline, jet fuel remain relatively stable. So this is where you're seeing a bit more of an export from Europe into West Africa, and you're starting to see some of it into the Americas. So the question is going to be, if they're importing from the Middle East, if they're importing from the US, well, then how does Latin America fit in? And this is something where we think there's going to be a little bit of a backfill where some additional flow is going to flow from the US. So even if Europe starts to slow down in terms of their imports, as they've already commissioned or signed on some of these tankers, you're going to see a little bit of an increase, specifically in gasoline going into some of these areas, especially with Pemex, who just announced that they're down about 8.8% month over month in terms of total refinery utilization, which puts them at about 36%. So you're also going to see some additional flow down into Mexico, which is also something that we're seeing in terms of Colombia. Europe, and this is where some of these movements are very strange. Latin America is pulling more in August, coming from Europe into the Americas at about 21 tankers. Again, those are signed up. So now we're going to start to see where does some of this fall on the margin, and some of that will be coming from the Gulf of Mexico, as we're starting to see some pricing discounts in order to get some of this product out of PADD 3 and into the remainder of the market. And this is, just to kind of round out where we sit, you can see that the trends are moving through the normal average in terms of where we're trending against seasonal norms as we look at the year over year back to 2017. The problem is going to be in terms of the 4-week average, where on a 4-week moving average, when we're looking at total U.S. product supplied, we're down about 2.2 million barrels versus last year. So this is something where we have to keep looking at, because this is where we think this is going to remain relatively sticky in terms of those declines. Now, week over week, we're down about 1.9 million. But again, we think that the averages are going to continue to drift lower, especially even though when we factor in exports kind of increasing over the next 2 to 3 weeks, it's still going to be relatively lumpy, and it's not something that's going to be very sustainable, especially as we talk about India oil demand, India exports increasing, China exports increasing. And when we look to Singapore, we continue to see Singapore stocks remain grossly elevated as we look through the seasonal adjustments. Fujairah had another decline of 777,000 barrels. Again, these are good things to see in terms of movements, but it still can easily be backfilled based on the amount of product sitting not only in the Middle East, but also in Singapore and in some other regions that you're continuing to see these boats make some weird moves. Just as you get this, you're seeing guys sell and then buy and then sell again, and you can. essentially it looks like they're doing the tango in the middle of the Atlantic or Pacific before they actually find a home. So these are things that are going to weigh on pricing, continuing to weigh on margin. But again, on the average, this was a decent report. When we start to look at things moving and starting to draw down, the question is, can we close that gap before we get to the fall season? And it just doesn't seem likely. So again, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Stay tuned for our economy show, which will be coming out on Thursday. And then obviously we have our favorite, the Frac Spread Count, coming out Friday. Thanks again.